When you deep dive into the socials, you can hear people discussing this coin gonna be the next 100x coin, or at this time we're gonna have a market bottom, and nobody talks about this, which is actually surprising to me, because this is way more simple once you understand the concept, and it will give you the highest returns once you implement it in the long run. Stay tuned. Hello guys, my name is Željko and welcome to Unsymmetric. As humans, we always tend to look for shortcuts in life, whether it's earning money, losing weight, or learning something new. But when we are looking at shortcuts, assessing their viability should be always the first step in my opinion. Most often, the biggest if not the only shortcut is falling in love with the process of what we are doing and just becoming better at the things we want to achieve. This is where compounding comes into play. So if you're looking to lose weight, you shouldn't be looking on how to lose 50 kilograms in a month with some ridiculous diet, because it's most likely that you will return it afterward, even if you manage to do it. Instead, you should maybe drop processed food, then add some proteins, then start adding some cardio, then go to the gym, and these gradual changes will add up and bring you to the place where you want to be. The same applies to financial and crypto markets. Instead of looking for one project that will give you 100x, learn more about investing principles, trading principles, technology, and how different things work, and apply these things in your decision-making process, and gradually these things will add up and lead to the exponential growth of your portfolio over time. Compounding interest is the process of earning interest on the initial investment and then reinvesting that interest to earn even more interest. So the longer this process continues, the larger your earnings will be. For example, let's say you invest $1,000 in a currency that has a 10% annual return. After 1 year, your investment would be worth $1,100. If you left that money in the market and didn't touch it, the next year it would earn additional 10% return on a new balance of $1,100, bringing you to total of $1,210, and so on. As you can see, the power of compounding really starts to kick in after a few years. After 10 years, your initial $1,000 investment would be worth nearly $2,593. That's almost 160% return, all thanks to the power of compounding. After 20 years, it becomes $6,727, which is around 570% return in comparison to the 200 return which you would get if you would be pulling out interest after every year, or if you would be earning yield on a simple interest. I will leave a calculator on compounding interest in the description below so you can play with it. The power of compounding in crypto markets is an incredibly powerful tool since crypto is a relatively new and volatile market. To earn compounding interest in crypto markets, you can utilize various products such as staking, yield farming, and liquidity providing, for example. I won't deep dive into each of them in this video, but you can earn anywhere from 0.2 to even up 100,000% yearly on some projects. Yeah, you heard it well, 100,000%. I will elaborate on this later in the video. On the more conservative side, Ethereum has around 5% APR and stablecoins are around 10%. So if you look into the period of 10 years, imagine the situation where you're buying 1 Ethereum every 1st January for the next 10 years. That's around like $1,200 per year or $12,000 in total. After 10 years, you would have 13.21 Ethereum instead of 10, which is like a 3.21 Ethereum gain, which is equal to $3,850 at current prices. If you have bought all that Ethereum in the first year instead of buying it through the years, you would now have 16.29 Ethereum, which is like 6.29 Ethereum gain or $7,550. Now imagine yourself in a scenario where you find a place to stake your Ethereum for 10% APR instead of 5%, and that you buy all 10 Ethereum in the first year, as we were looking in the second case. That would result in 10.61 Ethereum gain, which is currently $12,730. I have a small ask. If you find this video valuable, I would highly appreciate it if you could write in a comment section below which coins are you staking currently, or anything that comes to your mind, since it helps with boosting a YouTube algorithm to show this video to more people. Thank you. Now imagine that besides staking, you learned a little bit about market cycles and trading, and that you're able to identify to some point where we are in a current market cycle. Ethereum went 60x in the last market cycle from around $80 to almost $5,000, so we don't even need to look at this 60x return. Imagine that you bought Ethereum at $300, where it spent most of the time during the previous bear market, and that you sold it at 1,500, which is still really far from the top, but it's still 5x return from the initial investment in this case. Since the bull and bear markets change approximately every 4 years, you can repeat this 2 times, and let's say you did 5x the first time, maybe the next time, because markets are becoming more and more mature and we're gonna see slightly fewer multipliers in the future as the market cap is growing, we can calculate that we're gonna 4x this time maybe. So that's a total of 20x in just a few buys and sells. Imagine if you would apply some more advanced strategies as well. So if you add this to the previous sheet, that would be around 86k if you just did one 5x trade, and 380k in the second case where we bought 10 Ethereum in the first year. So we would still have 16.29 Ethereum multiplied by the initial price of $12,000, multiplied by the 5x in the first bull run and by 4x in the second, and we would just need to deduct 12k from the initial investment. This is insane, and that's pretty much for the blue chip altcoin like Ethereum, and there are going to be alts with the better gains and better moments to buy and sell as well. So imagine if you're able to improve any part of the process slightly, either better buying price, better selling price, coins which will give you high return on your investment, or do a few trades here and there. The possibilities are endless as long as you're looking to learn and improve. So we talked about the benefits of compounding, but the compounding effect can work against you as well. Why do you often hear from people don't loan money from loan sharks? Yes, you're right, it's because of the compounding. Most of them loan money at high interest, so if you loan $1,000 at 20% interest monthly, if you don't return that money in time, it becomes almost 3k after 6 months and almost 9k after a year. If you're paying $250 monthly, it would take you 9 months to pay off the debt, and you would be paying $2,210 instead of the initial $1,000 that you were supposed to pay. So be careful with loans. If you look specifically at crypto, maybe you heard for the projects like Olympus DAO and its forks like Wonderland DAO for example. These projects were pretty much based on the compounding, and at most of them you were getting around 10% every 5 days, which would result in a 2x gain on your initial investment in around 30 to 35 days. That pretty much means you would have 4,000x your initial investment in a year. Some of them offered even larger possible returns, but remember what I mentioned at the start of the video. Always think if some idea is even viable. Obviously this one wasn't, so the caveat here was that you were getting 10% on the number of coins and not on the dollar value. So as the time goes on, most of these coins depreciated highly. The majority of them depreciated over 90% in a month, while you had to hold around 3 months to pull your initial investment out. Another thing to think of is often when you're staking your tokens, they become locked for a certain period of time and you're not able to sell at any moment or at any price that you would like to sell. Instead, you have to hold tokens for a certain period of time. So personally, I would rather have a smaller APR but have an opportunity to unlock tokens and sell them when I want to, instead of having them locked for a year or even a few years. For example, if we take the two currencies that are the same price and we stake 10 coins of one currency at 5% APR and the second currency at 10% APR, and let's say after 10 years the first coin appreciates in price by 25% and the second depreciates in price by 25%. Even though you would have 26 of the second token and 16.3 of the first one, the total amount of money you would get in the first case is slightly higher. There are many other things that can lead to negative scenarios. For example, if you're investing in smaller coins, you need to ask yourself, is there gonna be enough liquidity on the buy side in order to sell? Diversification is another factor as well. So the earlier and larger amount that you invest, it will create a bigger compounding effect in the long run. After some time, the amount that you earn on a compounding interest will surpass the amount that you are able to invest regularly. Also, the more often that you can invest, the faster you will come to that stage where the rate of the compounding effect is insane by your standards, and it's better to focus on how you can compound more in comparison to anything else. I know that having a high return in your investment is tempting, but make sure to diversify your portfolio to mitigate the risk. Don't pull all of your eggs in one basket, because if the price of an asset drops highly, the high appreciation rate won't matter that much, and you don't want to hold zillion of coins that are worth nothing. Thank you for watching this video. Please write in the comments what are your favorite tokens that you're staking. Also, don't forget to subscribe and follow me on other social media from the video description. See you in the next video. I appreciate your support and have a wonderful day. Bye! Timing the market beats timing the market. Having perfect timing is almost impossible, but if you enter markets early enough, the compounding effect will hit in terms of knowledge, experience, and money as well. And yes, we are still early.